Hello everyone, welcome to Big Players.
In this video I am going to share the right way of using moving averages to generate consistent profits. By definition, a moving average is a technical indicator that calculates the average close price of an asset over a particular period of time. This means that a 10-period moving average will show the average close price of the last 10 candles. Different moving averages can be used to identify different trends. For instance, a 200-period moving average can be used to identify the long-term trend of the market. Similarly, a 50-period moving average can be used to identify the medium-term trend of the asset. And lastly, a 20-period moving average is used to identify the short-term trend of the market. For the purpose of this video, we will use the 50-period moving average. But you can apply any moving average and backtest it to see the results. So, why should we use the moving average indicator? Reason number 1. Moving average can help us in identifying the trend of the market. One of the basic uses of a moving average is that it clearly shows us the trend of the market. For instance, if the price is above the moving average, and the moving average is sloped upwards, we can say that the price is in an uptrend. Similarly, if the price is below the moving average, and the moving average is sloped downwards, we can say that the price is in a downtrend. Lastly, if the price is revolving around the moving average, and the moving average is flat, the market is said to be in a sideways trend. The second reason is that moving averages show change in the trend. Look at this chart. Here we can see that initially the price was in a downtrend. But after the break of the moving average, the price went into an uptrend. Hence, the break of the moving average can alert us to a shift in the trend. Here on this chart, we can see that the price was initially in an uptrend, then it crosses the moving average, and a strong downtrend begins. The third reason of using the moving average is that it often acts as a dynamic area of support and resistance. Here is the 50-period moving average. We have a clear uptrend here as the moving average is sloped upwards and the price is trading above the moving average. Look at these points. Here, the price makes a pullback and finds support at the moving average, and then reverses. Oppositely, in a downtrend, the price will often find resistance at the moving average. This indicates a possible trend continuation. An important point to remember here is that we will not use these reasons alone to make trades. Instead, we will use these points in conjunction with other concepts to initiate any trades. Now that we have understood the basics, it's time to learn the strategy. Let us understand it with an example. Here the blue line is the 50-period moving average. Firstly, we need to analyze the moving average and identify the trend. Looking at the moving average, we can see that the price is above the moving average, and the moving average is also sloped upwards. Hence, we can conclude that the market is trending upwards. Now in an uptrend, we will only be looking for buy trades. Now look at this point. As I said earlier, moving averages can act as a form of support in an uptrend. Hence there is a possibility that the stock could resume the uptrend after it touches the moving average. But this alone does not give us the permission to place a trade. Another thing to note here is that there is also a strong level of support here that has previously acted as a resistance. Hence, this area has a confluence of a support level and the 50 MA. We can now think about buying at this area. But when should we actually initiate a trade? For that, we will create a short-term trend line around the pullback. After this trend line is broken, we will initiate and buy order above the high of the candle that broke the trend line. For stop loss, we will keep our stops below the 50 moving average, and we will keep our target at 1:1.5 risk-to-reward ratio. As you can see, the price rallied after the break of this line. Here is a sell trade on the 5-minute chart. Here we can clearly see that the price is trading below the 50-period moving average, and the moving average is also sloped downwards. Hence, we can say that the price is in a downtrend. So we will look for short trades only. Here we see that the price has made a pullback and has come close to the moving average. The price is also at a major resistance level that has acted as a support in the past. There is a high probability that the price could reverse from this area and continue the downtrend. Hence, we create a short-term trend line and wait for the break of trend line to initiate a short trade. This candle breaks the trend line and hence we place a short trade below the low of this candle. We keep our stops above the moving average, and we keep our targets at 1:1.5 risk to reward ratio. As you can see, this trade generated profits. This is one of my favorite trades that recently occurred on the Euro-USD pair. Here we can see that the pair is trading below the 50-period moving average, and the moving average itself is sloped downwards. Hence, we have a short bias. Here we have a very simple short trade that occurs at the confluence of the 50-period moving average and a near support resistance level. We created a short-term trend line and shorted the pair after the break of this level. The down move generated good profits. All this was very simple, but the next pullback was a complex one. Here we see that the price comes right into the previous area of resistance. At this point the 50-period moving average is broken. This is the reality of the market. We cannot expect the market to reverse exactly at the moving average. Sometimes the market can push through a bit and then reverse, and that is perfectly fine. If the market breaks the moving average and starts making higher highs, then we can change our bias. In this scenario we are still having a downtrend bias. Hence we create a short-term trend line and wait for its break to initiate a short trade. But before the price breaks the trend line, we have a very good chart pattern that develops here. Can you spot it? Let us go down to a smaller time frame to see it. Here we are on a 1-minute chart. Here is the same short-term trend line and here is the R of resistance. We have a double top chart pattern that develops here. This is also a sign of a downtrend. Hence we have a triple confluence. The 50-period moving average, the resistance level, and now the double top pattern is also indicating a downtrend bias. These are high probability trades. In such trades, the chances of failure is much less. Hence, we should make the most of these trades by increasing our position size. We can also use multiple entries in such trades. For instance, I shorted half my position at the break of the trend line. And I shorted the other half at the break of this neckline of the double top pattern. This brings us to the end of this video. If you liked the strategy, then backtest it and use it in your trading. Be sure to like this video and subscribe to our channel, so that you don't miss on any of our new videos. See you next time.